All right, let's wrap up this chapter, shall we? Let's talk about the debt to equity ratio. Remember, the two ways a business gets their assets is either with debt or equity. A equals L plus E. So we're getting our assets through either debt or equity. So the debt to equity ratio is debt over equity. It shows the relationship between the capital provided by owners and that provided by creditors. A higher ratio indicates that we're relying more heavily on debt, which means more risk is involved, because remember, we have to pay back debt plus interest. It doesn't necessarily mean it's bad, but it definitely means that it's more risky. The more liabilities the company has compared to their equity, the more of their assets that are effectively owned by the bank, and that obviously is more risky for the company. So really, with any ratio, you need to compare from year to year of the same company or compare the company to its competition to determine the good or the bad. Generally, we want a lower debt to equity ratio because it imputes less risk. Sometimes we may decide to pay off bonds early. The reason for that is just the same reason I would pay off a loan that I have early. I may pay off a loan early because I have the cash and I want to save interest, or because I want to refinance the loan at a lower interest rate because market rates have went down. We're not going to do any of the journal entries involved for the early retirement of bonds. However, you should understand that if the book value of the bond is greater than the cash paid to retire the bonds, it means we were able to retire the bonds at a gain. And if the book value is less than the cash we pay to retire the bonds, then it would mean we had a loss. Why would the book value and the cash paid be different? Well, the book value is the amount it's recorded on the books for. The cash amount is the market value of the bond, which changes based on market interest rates. We're not going to calculate any of this. You're not even going to have to calculate the gain or loss, if I'm being honest with you. But you should just know that when a company retires bonds early, number one, why would they do it? To save money, either by eliminating interest or refinancing at a lower interest rate. And when they do, gains or losses could happen. If you know that, good enough for me. So the price of bonds go in the opposite direction of interest rates. So as market interest rates go up, it's going to lower the price of the bonds because it effectively is going to mean that the stated rate is lower compared to the market rate. And when that happens, the price of bonds would go down. How are bonds shown on cash flows? Well, like any long-term loan, long-term debt and equity goes under financing. So when we borrow money from banks or from bondholders, that money shows up as a financing cash inflow. And when we pay it back, it's an outflow. The interest, however, paid is an operating cash flow. Don't forget that. Interest paid relates to interest expense, which relates to revenue and expense items. And revenue and expense cash flows belong in the operating section. So it's only the parts related to the face value of our bond, whether it's coming in or out, that goes in the financing section. The interest paid part goes in operating. And believe it or not, that's all there is to Chapter 10. As with all chapters, practice is extremely important, so please look at all the resources available on both Canvas and Connect. Utilize those resources, reach out on the discussion boards with questions, and or email me to schedule a Zoom office hours appointment.